What's going on, guys? It's Kyle. Welcome to the Stock Goat YouTube channel. In today's video, we're going to be covering the SoFi stock. And guys, I got to be completely honest. I'm getting more and more excited when I'm starting to make these videos. Now that SoFi has showed its true colors and turned a profitable quarter, I am already itching to get to Q1 and see those numbers, guys. I am telling you right now, this management team is gearing up to print billions of dollars in the next couple of years. And I think we are really going to start to see some of the other portions of the business start to play out like a Galileo in 2024, guys. I think Anthony Noto has something up his sleeves. And if we get those rate cuts that we've potentially been talking about the past couple of weeks, I just forgot that SoFi, who owns Galileo, all of those companies are going to benefit massively in a lower rate environment. Remember, guys, we've been targeting more larger, durable banks in the past couple of months, but we still have, dozens and dozens of fintech partners who are waiting to see a lower rate environment. And I think you're going to see growth accelerate during rate cuts for those companies. Remember, other fintech success is also our success. So think about it, guys. Right now, I think SoFi is probably the top two player in the United States for fintechs. Obviously, number one is Chime, but they are still in the private markets. And we power Chime with Galileo. Chime is using SoFi's technology, guys. What does that show you? We are gearing up to get that fintech multiple in the near future if Galileo growth can accelerate. We are already reaching profitability for Galileo for the past 2 years. Margin expansion looks solid. Now it's time to hit that top line for all of those players that we're potentially going to be signing on the next couple of years, guys. So I think Galileo is going to be taken off in 2024. And that's why I'm more excited than ever to bring you these videos, because we keep getting more and more people to the channel. And I get to recommend the SoFi stock at crazy low levels for new people, guys. Don't think you're missing out, because people that have been in the stock for a while, this is your time to DCA. And people that are new to the stock, you're getting in at ridiculous, 1 year levels below SPAC, 3 years ago levels. This is insane. I'd rather be recommending SoFi right now than having to recommend SoFi at $20, $30, $40, putting more pressure on investors that have to buy the stock, higher and higher as the valuation grows. For anybody new to the channel, we've covered it on the last couple of videos. SoFi management has incentives, massive bonuses to hit $45 per share in 2026. Not the end of 2026, July 2026. So once again, we're going to get into this video. It's a good one for you today. If you find any of this information useful, please smash the like button for the YouTube algorithm. Don't forget to drop a comment. I'm going to be commenting back to as many people as I can. And don't forget to subscribe to the channel. We're trying to grow the channel past 20,000 subscribers, so more and more people can learn about the SoFi stock. Let's get into it. All right, guys, we're going to do a 20-second recap on anybody, covering the stock right now. For today, S&P 500 was flat, Dow up a little bit, NASDAQ flat. That is a little bit strange. Russell 2000 small cap. That's what we want to see. We've been seeing this bad boy get hammered for a year, up about 0.85%. And when you see this thing move, you usually see small caps move. And what I've been telling you guys is I'm looking to buy small caps, but I'm not touching unprofitable small caps. I'm touching profitable small caps. That's exactly the category that SoFi's in. We got 2.9% green on the day. Market cap is ridiculous low levels at 7.6 billion. That's a price to sales under 3. Just ridiculous. And guys, look at this. This is literally breaking news coming at you right now. This is insane, guys. Look at this. Dumb move. Look at JP Morgan Chase doing the exact opposite of what they should be doing right now. Big egos will run them into the ground. Of course, this part is just my personal opinion before we get to the, part. 20 years from now, all of their customers will be pulling up in wheelchairs. So that's what I said, and that's what I think is going to potentially happen, because Jamie Dimon just made a huge move. Look at this, guys. JP Morgan Chase plans to open over 500 branches in multi-billion-dollar expansion. Was this the move to be making in 2024 when we're entering a lower rate environment and fintechs are going to be absolutely skyrocketing? Guys, they're not even worried about the newer generation of customer. They're still worried about their old legacy customers. Guys, this is updated for 2023. Look at this. U.S. banks closed 3,000 branches last year. Last year, 3,000 U.S. bank branches closed as lenders look for ways to fight competition from fintech and digital banks and keep pace with the technology. What did I just tell you in the beginning of the video? SoFi has invested over $2 billion in technology. They have acquired companies at pretty high valuations, guys. It's going to take SoFi a while to get those valuations back from where we purchased them at. But I'm telling you right now, SoFi is making strides of acquiring as many accounts as they can in Galileo. And I think we're going to see some big legacy players move on to the Galileo platform, and you're going to start seeing top line revenue absolutely explode. Kind of what you're seeing in the digital transformation right now with AI. So basically, AI is getting the massive boom when you're seeing a lot of these artificial companies just absolutely explode, and fintech is now left in the dust, and we're basically priced at legacy bank valuation. So fintech isn't getting any multiples right now, guys. Wait till it comes back. Wait till we get this lower rate environment and you see all of these fintechs start to print money. I think JP Morgan made a massive mistake right here. Note that the number of bank closures varies widely by area. Between 2017 and 2021, more than 7,000 branches were closed in the US. So it's accelerating faster. The closing of branches is accelerating faster. And that's the pivot that our largest competitor, JP Morgan, is making right now. Drop a comment. What do you think about that move? Where are their customers going to be at in the next 20 years, okay? Who's going to be banking with them? Are they going after the millennials, the Gen Zs? What are they doing right now? Like I explained in the beginning of my video, guys, I said, wow, I forgot all of Galileo fintech partners will strive in a lower rate environment. And I'm over here just focusing on SoFi on its own when SoFi owns all the technology. Guys, they own Galileo. Galileo owns 140 million accounts, hundreds of companies, and they power all of those fintechs. The fintech boom will be massive the next 3 years. Galileo partners growth equals SoFi growth. Guys, these are some of the partners you're looking at right here. Toast, Monzo, Chime, Robinhood. These are huge companies. Every company here is probably over $5 billion. And a lot of them have seen, stagnant growth the past couple of years in this environment. Wait till we get booming again in lower rate environment. I'm telling you, Galileo should be taken off again without adding additional partners. We're a proven financial technology platform, an innovation engine, and a leader in card issuing, payments, and digital banking. So this is the top three that these fintech partners are coming to Galileo for. Every day we partner with big thinkers like you to reinvent the way people interact with their money and build a better financial future for us all. I just want you to scroll down and take a look at this. Guys, look at this. This is absolutely awesome how Galileo has this. This is how they're acquiring these customers. Look, it just keeps rotating. Look, Dave, Moneyline, Monzo, SoFi, Toast, Lily, Bluevine, North One, just a lot of these top companies you probably have heard of. H&R Block. I mean, guys, I'm telling you right now, a lot of people that are bashing SoFi as a bank right now don't even know what's going on. In my personal opinion, I'm going to give Galileo right now like a C plus because of its growth. They have the accounts, they have the technology, but if they can get these large banking partners over to the platform, we're going to be at an A plus. I'm grading it right now at a C plus because we just saw revenue growth of 13% this quarter. Last quarter was 6%. So you're seeing the acceleration. But guys, I'm trying to get into the 30%, the 40% range for the next couple of years. Understand it is profitable right now, but this is where we need to see the growth to get that tech hybrid multiple that people just don't understand that SoFi owns this technology right now in Galileo. They just think it's a bank, a lender, 100% lender. Guys, SoFi has a goal to get to 30% lending as fast as possible, and Galileo expanding is going to help do that. Just to give you guys a little bit of an update, I wish we could have saw a little bit greener of a day. These are the tech companies that we followed. Lending Club, a little red, New Flat, Coin Decent, Square, Hood, and then SoFi finished up in the middle tier right here. And then you got PayPal, Upstart, and Affirm getting a nice boost. So as you can see, we kind of run with these companies. When these companies run, we kind of run with them. But the difference is SoFi is killing it on earnings, and a lot of these companies aren't. If we get some rate cuts, this is what you're going to see absolutely explode. This is the IWM iShares Russell 2000 ETF, and you can see in the past 12 months, it's done absolutely nothing. This is what controls the small caps, guys. Unprofitable stocks in here, profitable, a bunch of them, but I'm just trying to tell you, if we get some rate cuts, you're going to see this thing start booming again to potentially, 220, 250, which is all-time highs. And that's where you're going to see SoFi potentially take off. So this thing is a big reason why SoFi has been down the past 1 to 2 years, because it's done absolutely nothing. So really start to watch this IWM, because QQQs has been absolutely mooning for 2 years. If we can see a reversal or flatten the QQs, we will see the IWM finally take off, guys. So be watching this chart. Now, guys, I already told you basically to get to the bonuses of where SoFi needs to be at by 2026, we need to be at like a 50 PE ratio on $1 billion of net income, which I personally think is possible. Because, guys, take a look at this. There's been so many different sectors that have had significant impact from high technology, high growth companies that have just come in these legacy markets and just smoked the competition. It's exactly what you see from Tesla. Look right here, guys. Tesla is trading at a 42 PE ratio right now, okay? And you've also seen the stock fall like 200 plus dollars, okay? So actually, if it was back to like all-time highs, you'd be talking like an 80, 90x PE. But you got to understand, this is a car manufacturer. They have, technology. And look at some of the legacy bank competitors that have been around so much longer, but don't have the growth. This is where you get the PE compression that I've been talking about that will happen for banking. Ford Motors, a 7.5 PE. Look at the difference, guys. You're talking a 500% difference in PE ratios. Why is that? It comes down to growth. Growth, growth, growth. Tesla is growing faster than Ford by a significant amount, and you're seeing the PE multiple on a 7 on a Ford and then a 40 on a Tesla. Take a look at retail. We got Walmart right here trading at a 28 PE ratio, which I think is pretty dang high for how low a Walmart's margins are. And you got Amazon right here trading at a 58x PE, okay? Almost doubled. So I think Walmart's already high and Amazon's doubled. Amazon could probably go up higher from here, back to like where it was, like an 80x, okay? So think about that, guys. You have companies that come in these legacy markets, disrupt the markets because of growth and innovation, and you get an expansion on your PE multiple. And the companies that have slower growth get a PE compression. And this is what we are going against. Morgan Stanley, PE ratio of 17x. I know a lot of people like to talk about PEs of like 9, 10x. Those are the slowest banks growing in the world, okay? Morgan Stanley is supposed to be innovation, but in my personal opinion, I've looked at the net income the past 5 years. You guys seen it on my Twitter. Zero growth in the past 5 years on net income. No growth at all. And these guys are getting a 17x PE multiple. This is the company that is downgrading SoFi on profitability and 35% growth. Think about that for a second. Zero growth company downgrading us, and they have one of the higher PE multiples, guys. We could absolutely destroy this PE multiple in the next 3 years if we remain profitable and we see Galileo take off. 17x PE. I'll put a triple from where this crap is, this legacy garbage. We're going to be at a 50x PE in my personal opinion. And that's if SoFi just hits the numbers that they are looking for. If you made it to the end of the video, I want to say I really do appreciate it. I enjoyed doing this video for you. Once again, I'm very excited for all the people that are following the channel. You don't understand the levels that SoFi is trading at right now. These guys just hit gap profitability, and they are looking for massive net income expansion over the next 2-3 years. This is the best time to be buying the SoFi stock. Make sure to do your due diligence. I don't want to be recommending this stock to, thousands upon thousands of new investors when this thing cranks off to $20, $30, $40 in the next couple of years. So understand this is a great buying opportunity. Once again, my name is Kyle. Do your due diligence. Thank you for watching the Stock Goat YouTube channel. Have a great day.